If you receive Social Security, are approaching retirement, or are still working and building your future benefit, there is something important you need to understand about 2027. Most people are hearing that major Social Security changes are coming, and that phrase can make it sound as though Congress has already passed a completely new set of rules that will suddenly change everyone's check. That is not the full story. The reality is more important, and in some ways more useful. Some numbers for 2027 will be adjusted automatically under existing law. Some of those numbers are not known yet because the government calculates them later in the year, and some of the most dramatic changes you may see discussed online are only proposals for changing Social Security, not rules that have already been enacted. But underneath all of that is a much bigger issue. The latest Social Security Trustees report says the combined Social Security trust funds are projected to have enough reserves to pay all scheduled benefits until 2034. After that point, under current law, and without legislative action, continuing income would be enough to pay about 83% of scheduled combined benefits. The Separate Retirement and Survivor Fund, known as OASI, reaches its projected reserve depletion earlier, in 2032, with continuing income then sufficient to pay about 78% of scheduled OASI benefits. That does not mean your check is scheduled to suddenly fall in 2027. It means the decisions surrounding Social Security are becoming increasingly important before the end of this decade, and once you see the numbers clearly, you understand why 2027 matters more than most people realize. Let's start with the number almost everyone will be watching: the cost of living adjustment. The 2027 Social Security COLA has not been officially determined yet, and that is important. The Social Security Administration calculates the annual adjustment using a formula tied to inflation, and the relevant figures are determined later in the year. SSA says these automatic increases are published in late October. So if someone tells you today that the exact 2027 COLA is already locked in, they are giving you a number that is not yet official, but there is an estimate under the intermediate assumptions in the 2026 Trustees Report. The projected 2027 COL is 2.4%. Again, that is an estimate, not the final number. Now consider what 2.4% actually means. If someone receives $1,800 a month, a 2.4% increase would be about $43 a month, before considering any other changes affecting their household budget. On a $2,000 benefit, it would be about $48. On $2,500, about $60. That sounds straightforward. But this is where people often make their first mistake. They look at the percentage and mentally spend the entire increase. Social Security is not the only number in your retirement budget. Medicare premiums, taxes, prescription costs, housing, utilities, insurance, and food can all move independently. So a 2.4% increase in your Social Security benefit does not automatically mean your purchasing power rises by 2.4%. And that distinction becomes especially important for households whose Social Security check represents most of their monthly income. The second issue is the set of wage-related numbers that Social Security adjusts every year. The taxable maximum is the amount of earnings subject to the Social Security payroll tax. For 2026, that maximum is $184,500. The 2027 number has not yet been officially announced. That number matters most if you're still working and earning above the taxable maximum. For someone earning below the ceiling, the change may have no direct effect on their paycheck. For a higher income worker, however, an increase in the taxable maximum can mean that more earnings are subject to the Social Security portion of payroll taxes. And there's a second reason this matters. The wage history used in Social Security's benefit formula is important when determining future benefits. So Social Security isn't simply a retirement check you receive at 62, 67, or 70. It is a formula that connects your earnings history, the wages in the economy, your claiming, age, and annual adjustments. That is why people who are still working should not look at 2027 only as a retiree issue. For a 3-5-year-old worker, the 2027 rules are part of a much longer accumulation period. For a 5-5-year-old worker, they may affect decisions about the final decade before retirement. And for someone already receiving benefits, they are much more directly connected to monthly cash flow. This brings us to one of the most misunderstood issues surrounding 2027: the retirement earnings test. If you claim Social Security before full retirement age while continuing to work, there can be limits on how much you can earn before benefits are temporarily withheld. For 2026, the earnings limit for someone under full retirement age for the entire year is $24,480. The rule is generally that $1 in benefits is withheld for every $2 earned above the limit. For someone reaching full retirement age during 2026, the applicable earnings limit is much higher, $65,160, and the withholding formula is less severe. And once you reach full retirement age, the earnings test disappears. The 2027 thresholds will be adjusted later. So if you're planning to work while claiming benefits in 2027, don't build your retirement budget around the 2026 number. Wait for the official 2027 figures, but understand the structure now, because this is where many people get caught. They hear the phrase, Social Security will take your money if you work, and assume the withheld benefits are permanently gone. That is not how the system works. Benefits withheld under the earnings test are accounted for in the benefit calculation after you reach full retirement age. In other words, this isn't simply a penalty for working. The timing can still affect your cash flow, and it can absolutely affect whether claiming early makes sense for you. But the popular idea that the money is simply confiscated and disappears is misleading. That distinction can change how someone thinks about a part-time job, a delayed claim, or the timing of retirement. And that leads directly to the bigger question: should you even claim Social Security as soon as you're eligible? This is where the difference between a reactive household and a strategic household becomes very clear. The reactive household asks, when can I start collecting? The strategic household asks, what claiming age produces the best outcome for my entire financial situation? Those are two very different questions. If you're nearing 62 and have little retirement savings, starting Social Security early may look attractive because it creates immediate cash flow. But claiming early generally means accepting a lower monthly benefit than you would receive by waiting longer. If you're healthy, have other income, and expect to live for many years, delaying benefits can become much more valuable. On the other hand, if you have limited resources, significant health concerns, or a strong need for current income, waiting may not be realistic. There is no universal claiming age that works for everyone. The mistake is treating 62, full retirement age, or 70 as automatically correct. Your Social Security decision should fit your cash flow, taxes, longevity, expectations, spouse's benefit situation, and other retirement assets. And this is where 2027 becomes psychologically important. Because when people hear about the trust fund projections, they often make one of two mistakes. They panic and claim immediately because they're afraid Social Security will disappear. Or they ignore the issue completely because retirement is still years away. Neither response is particularly strategic. The trustees' projections do not say Social Security disappears in 2034. They say that under current law, the reserves are projected to become depleted and continuing income would then cover only a portion of scheduled benefits unless lawmakers change the system. That is a financing problem. It is not the same thing as saying the program stops paying. The distinction matters because panic can be just as expensive as complacency. Now here's the part almost no one talks about. The biggest potential changes associated with 2027 are not necessarily changes that have already been passed. The Social Security Administration's Office of the Chief Actuary publishes numerous proposals for changing the program. Some proposals would begin in 2027. For example, one proposal would reduce the annual COLA by 1 percentage point, beginning in December 2027. Another would reduce it by 0.5 percentage point. Another proposal would change the inflation measure used to calculate the COLA. There are also proposals involving the taxation of higher earnings, and proposals that would change the normal retirement age, beginning with people reaching age 62 in 2027. But these are proposals, they are not automatic 2027 law. That distinction is absolutely critical. If you see a headline saying, Social Security COLA will be cut in 2027, you need to ask a simple question. Has Congress actually enacted that change? The existence of a proposal on an SSA actuarial page does not mean the proposal has become law. This is one of the biggest problems with Social Security information online. A legitimate government document can contain a hypothetical policy option, and someone can turn that option into a headline that sounds like an upcoming rule. Then the headline gets repeated. Then people make financial decisions based on something that was never enacted. That's exactly what strategic financial planning is supposed to prevent. Now let's bring this down to your household. If you're 30 or 35, 2027 should not make you panic about Social Security. It should remind you not to build your entire retirement plan around one government program. You have decades of earning potential ahead of you. Your biggest advantage is time. Even relatively modest retirement contributions can compound over several decades. The goal is not to predict exactly what Social Security will look like in 30 years. The goal is to build enough independent financial capacity that Social Security becomes one part of the plan rather than the entire plan. If you're 50 or 55 and feel behind, the situation is different. Your advantage is no longer decades. Your advantage is decision quality. At this stage, you should know what your estimated Social Security benefit looks like, how much you have saved, what your fixed monthly expenses are, and how much additional income you could realistically generate. This is where the median versus average problem matters. National retirement statistics can make retirement look comfortable because averages are influenced by households with substantial assets. But your retirement is not an average. Your mortgage isn't average. Your rent isn't average. Your medical expenses aren't average. Your Social Security check isn't average. Your household has its own numbers, so build your plan around your own numbers. And if you're approaching 62, this is the point where claiming Social Security becomes a strategic decision rather than simply an administrative event. Before you claim, run at least 3 scenarios. What happens if you claim early? What happens if you wait until full retirement age? What happens if you delay longer? Then compare those Social Security amounts against your actual spending needs. Because the question isn't simply how much can I get? The question is, how much reliable income will I need for the rest of my life? And if you're already retired, there are several things you can do this week. First, log into your Social Security account and review your earnings record. Errors in an earnings record can affect future benefits, so don't assume the government's record is automatically perfect. Second, look at your latest benefit estimate and compare it with your actual monthly spending. Third, if you're working while receiving benefits, make sure you understand the earnings test, rules that apply to your age and situation. Fourth, don't budget around an estimated 2027 COLA as if it were guaranteed. The official number comes later. Fifth, calculate how much of your retirement income comes from Social Security. If the answer is nearly all of it, that tells you something important about your risk exposure. Sixth, examine your fixed expenses. A household that reduces recurring expenses has effectively created a permanent increase in financial flexibility And seventh, don't make a major claiming decision because of a viral headline. Verify the rule first, then run the numbers, then make the decision, because the two households emerging in the next phase of retirement aren't necessarily households with the highest incomes. They're the households that understand the difference between information and action. One household sees a headline saying, "Social Security is changing," and immediately reacts. The other household asks which change is actually law, which number is estimated, which decision is mine to control. That second household has a tremendous advantage, not because it knows the future, because it doesn't need to know the future perfectly, it simply needs to understand the structure, and the structure right now is clear. Social Security is still scheduled to pay full benefits under current law before the projected trust fund depletion dates. The 2027 COLA is not yet official, although the latest trustees' intermediate projection is 2.4%. The 2027 earnings limits and taxable maximum will be determined later through the normal annual adjustment process. The retirement earnings test remains relevant for people claiming before full retirement age while working, and the most dramatic 2027 changes you may see online include proposals that have not become law. That last point may actually be the most important one, because financial security doesn't come from reacting faster than everyone else. It comes from reacting to the right information. The Social Security system is changing gradually through formulas, demographics, wages, inflation, legislation, and long-term financing pressures. That means your strategy should change gradually too. Don't panic because of a projection. Don't ignore a projection either. Don't claim benefits early simply because you're afraid the system will disappear. And don't delay benefits simply because someone online told you waiting is always better. Your financial life is more complicated than any one rule. For younger workers, the goal is diversification of retirement income. For workers in their 40s and 50s, the goal is strengthening savings and understanding future income. And for people approaching retirement, the goal is coordinating Social Security with other assets and expenses. And for current retirees, the goal is protecting cash flow while staying informed about legitimate changes. The most important question isn't whether Social Security will look exactly the same in 2027. It almost certainly won't. The better question is whether your household is prepared for the system to evolve. Because small differences compound. A slightly different claiming age can affect decades of monthly income. A few $1,000s of additional retirement savings can create more flexibility later. A lower recurring expense can reduce the amount of income you need every month. And a decision made calmly today can prevent a much more difficult decision 5 years from now. So when you hear the phrase major Social Security changes coming in 2027, don't panic. Pause. Separate current law from proposals. Separate estimates from official numbers. Separate national statistics from your household's actual numbers. And then ask yourself one question: if Social Security changed somewhat differently than I expect, would my retirement plan still work? If the answer is yes, you're building resilience. If the answer is no, 2027 isn't something to fear. It's a reminder to strengthen the plan while you still have time. And I'd like to know where you are in that process. Are you already receiving Social Security? Approaching 62, still working, or decades away from retirement? And when you look at your own retirement plan, is Social Security one part of the plan, or does it feel like the entire plan? Leave your situation in the comments. And if you want calm, fact-based updates on Social Security, retirement rules, taxes, inflation, and the financial decisions that can affect your household, consider subscribing. Because the goal isn't to predict every change before it happens, the goal is to understand what changed, what didn't, and what you can actually do about it.